welcome to the week that was.
Great to be here.
If you were just watching the charts this past week, you probably felt some serious whiplash.
Oh, absolutely.
The price action, it just screamed fear, panic, volatility. Bitcoin was fighting for its life, really, trying to hold that $85,000 level.
But that was only half the story.
Not even half. Beneath the surface, the story was, well, it was one of monumental, almost historic, structural change.
Right. We saw the actual plumbing of global finance being rewritten, and not by startups. We're talking nation states, global payment giants.
It's this incredible cognitive dissonance. On one hand, you have all this market noise, the macro anxiety, the liquidations, the price correction.
And on the other, you have this incredibly clear signal, the deepest corporate and sovereign infrastructure integration we have ever seen.
So our mission today is to filter out that noise for you and really focus on those fundamental upgrades, because they really change the entire thesis.
They really do.
Okay, so let's start with the pain, the volatility.
The charts.
The immediate technical failure really came when the market just couldn't hold 90,000.
That psychological level. Once that broke, things got ugly fast.
We just saw this rapid descent into the mid-80s, clinging to that line in the sand everyone had pegged around 85,000.
And the reason it was so brutal wasn't just soft demand, it was leverage.
So many people were betting on the rally continuing.
The market was incredibly over-leveraged long. So when the price slipped, it triggered this massive forced selling event. We saw almost $500 million.
484 million, I think, in one 24-hour window.
Just flushed out. It's a classic waterfall effect. Shakes out all the weak hands.
And you could just feel the fear in the metrics. They dropped into extreme fear.
Some indexes were showing as low as 11 or 16. I mean, that's pure panic.
So you get that panic, you know the leverage is gone, but what was the initial trigger? What made the institutions pull back in the first place?
It was global macro. And the trigger was all the way across the world. The Bank of Japan. They voted unanimously to raise their benchmark interest rate to 0.75%.
Which doesn't sound like a huge number on its own.
But it's a 30-year high for Japan. And it signals a huge shift in global liquidity.
Okay, hold on. I get the Fed connection. That's pretty direct with risk assets.
Sure.
But the Bank of Japan, why does their decision immediately yank hundreds of millions out of Bitcoin? It feels a little abstract to me.
It's all about something called the yen carry trade.
Right.
For decades, Japan's interest rates have been ultra low, 0, sometimes even negative. That made the yen the world's favorite currency to borrow in.
This is cheap.
Exactly. So hedge funds, institutions, they borrow cheap yen, convert it, and then invest it in higher-yielding assets all over the world. Stocks, real estate, and yes, speculative assets like Bitcoin.
It was a massive engine for global liquidity.
The massive engine. So when the BOJ raises rates, it makes borrowing that yen more expensive.
Right.
All those strategies suddenly become unprofitable, or at least much riskier.
And the money have to come home.
Precisely. It's like a liquidity sponge, just pulling that risk capital out of the system. It prompts immediate strategic de-risking from the big players.
And we saw that de-risking happen instantly in the ETFs.
We did.
The spot Bitcoin ETFs, they recorded a net outflow of around 497 million for the week.
And that $500 million outflow, that confirms the macro response. But here's the really surprising part.
BlackRock.
BlackRock's IBIT, the unstoppable juggernaut of inflows. It actually saw net outflows on 3 of the 5 trading days.
Wow.
When you see the standard bearer for adoption start selling, you know for a fact that institutional risk managers are tightening their books.
So if that was the macroeconomic hurricane, the next part of this story is the physical shock to the network.
A huge one.
We saw this sudden massive disruption in the Bitcoin mining world, something that in the past would have signaled total disaster.
You're talking about the Xinjiang shock.
Exactly.
Coordinated enforcement actions in China's Xinjiang region led to the shutdown of, about 400,000 mining rigs? Just off.
The scale of that is hard to grasp. The global hash rate, the network's processing power, it plunged by about 100 exahashes per second.
And 100 EHs is an enormous number. I mean, that's roughly the size of the entire global network just 4 years ago. Wiped out in a day.
And the immediate fear, of course, is miner capitulation. These distressed miners have to sell their Bitcoin to cover costs.
That's the traditional thinking, the short-term pain. But the long-term signal here It completely overrides that fear.
Why?
Because this shock just accelerated the convergence between Bitcoin mining and the biggest tech story in the world right now, AI.
Okay, this is where the narrative fundamentally shifts. You have to tell us about the HUD-8 deal. This wasn't just a big contract.
No, not at all. It was a structural transformation. HUD-8 announced a $7 billion 15-year lease deal for energized infrastructure.
$7 billion. And who are they leasing to?
AI powerhouses, Anthropic and FluidStack, with reports that Google is backing the partnership. HUD-8 is providing up to 2,295 megawatts of power.
That's enough to power a major city.
It is. So miners are no longer just speculative Bitcoin plays.
They're being valued as real estate, as landlords of energized power. This is that energy arbitrage thesis, right?
That is exactly it. Energy is the bottleneck for AI. Bitcoin miners have the power, they have the infrastructure, and now AI companies are paying for it with massive, long-term, fixed revenue contracts.
A 15-year lease.
Right. It puts a structural and industrial floor under the valuation of these mining companies. It makes them independent of Bitcoin's daily price swings.
And other miners are acting on this. CleanSpark, for instance.
A very mature corporate move. They raised $1.15 billion with a convertible note.
And immediately used a huge chunk of it, $460 million, to buy back almost 11% of their own stock.
That is a massive vote of confidence. They're telling the market, our equity is deeply undervalued relative to our new value as an infrastructure provider.
That pivot from speculative asset to essential infrastructure, that leads us perfectly into how nation-states are now looking at this.
The Bhutan story.
The story out of the Kingdom of Bhutan this week is, it might be the most significant long-term blueprint we've seen yet.
It's genuinely remarkable. The royal government of Bhutan committed 10,000 BTC.
It's about $1 billion.
To finance their huge national development project, the Jalefyu Mindfulness City.
So what makes this so revolutionary? It's not just that they're using Bitcoin.
It's how they got it. This is the Bhutan model.
Yeah.
They didn't buy it on the open market with debt.
They mined it.
They mined it. They used their massive hydroelectric surplus energy that would have just gone to waste to mine Bitcoin at a near zero cost basis.
So they're literally converting excess renewable energy into hard currency collateral.
To get foreign direct investment. They're financing national infrastructure without taking on foreign debt. It's a fundamentally new model of state resource management.
Converting surplus electrons into a durable global reserve asset.
It's a model that any resource-rich, capital-poor nation could replicate. And it adds another layer, too. They chose the Solana blockchain to issue Tether, their national gold-backed digital asset.
Which shows state-level confidence in these public chains.
Exactly. It's not just about Bitcoin anymore.
And speaking of speed and reliability, this brings us to the biggest piece of commercial plumbing that was laid down this week, Visa.
A true watershed moment. Visa launched live USDC stablecoin settlement on Solana in the U.S.
Explain what that means in simple terms.
Well, Visa processes billions of transactions. Historically, banks settle up with each other using slow, expensive old systems like ACH or SWIFT.
Which only operate during business hours.
Right. Creating what they call float, where money is just sitting idle between accounts. Visa's integration lets banks like Cross River Bank bypass all of that.
They can manage liquidity and settle obligations 24/7.
Using USDC on Solana, this is a direct existential threat to the old banking models that make money off that float.
So stablecoins are no longer a fringe tool. They're now core infrastructure for the biggest payment network in the world.
And it's not just Visa. Look at SoFi Bank.
They launched SoFiUSD, the first stablecoin issued by a nationally chartered U.S. bank on a public blockchain, Ethereum.
And the fascinating part is the backing. It's one-to-one with cash held directly at the Federal Reserve.
Wow.
A regulated U.S. bank is using a public open-source blockchain as its settlement rail. That is the highest level of validation you can get.
And just to top it all off, we saw MetaMask finally launch native Bitcoin support for its 30 million users.
It's all about making the infrastructure seamless. Invisible.
Right. Now, none of this could happen without some regulatory clarity, and the shift in the U.S. this week was pretty significant. Let's start with a big win at the SEC.
Right. The SEC issued guidance on Rule 15c3.3, the Customer Protection Rule.
This is the rule that tells Wall Street broker-dealers, your Morgan Stanleys, your Goldman Sachs, how they have to hold client assets.
And historically, it required physical possession. That was always the sticking point for digital assets.
What does physical possession even mean for something that's just code?
Exactly. The new guidance clarifies that maintaining exclusive control of the private keys, that satisfies the requirement.
And why should you care?
Because that's the green light for Wall Street's prime brokerage and wealth management divisions to fully integrate Bitcoin. It removes a massive legal barrier.
It's a huge institutional unlock.
Huge. And then you had the Financial Stability Oversight Council, the FSOC.
They removed cryptocurrency from their list of systemic financial threats in their annual report.
Another major de-risking signal for the whole banking system. Plus, we got confirmation of pro-crypto leadership at the CFTC and FDIC.
It really feels like an end to that unofficial shadow ban on crypto banking.
It does. But that's the clarity side. Against that, we have this terrifying legal warfare brewing.
A truly existential legal threat.
This is where we need to slow down. A class action lawsuit against the Solana platform Pump Fund was amended to include ARIA charges.
The Racketeer Influenced and Corrupt Organizations Act. That's usually for the mob.
Right. But here's the critical part. It didn't just name the platform. It named the infrastructure providers, Solana Labs and Jito Labs, as co-defendants.
Why is that so terrifying?
Because if the courts accept that protocol developers are liable for how people misuse their neutral open-source network,
Even if they had nothing to do with the crime itself.
it shatters the entire defense of permissionless systems. It could force any U.S.-based developer to build censorship into their protocols or face massive criminal liability.
It targets the builders, not just the
Yep.
bad actors.
A very dangerous precedent. At the same time, though, you are seeing a cleanup of past messes. The liquidators for Terraform Labs filed a $4 billion lawsuit against Jump Trading.
Alleging they manipulated the USD stablecoin peg back in 2022.
It signals that the legal reckoning for those big market failures is finally moving forward.
So with all this contradiction, fear on one side, sovereign adoption on the other, it's no surprise that two completely opposing long-term outlooks emerged this week.
You had the bear thesis, citing demand exhaustion.
This was CryptoQuant, formally declaring a bear market.
They're basically saying the big catalysts, the ETFs, the corporate buying, it's all priced in now. And they're projecting a potential downside target of $56,000.
And their argument for that fragility is about market structure. They say that new whales, new entrants, hold about half of the realized cap.
And they have a high cost basis, meaning they bought in high, and they are far more likely to panic sell in a downturn.
Okay, so that's the bear case. But then you had the institutional forecasts, which well, they completely reject that.
Completely. They see this dip as just a cyclical interruption. A city is still holding a base case target of 143,000 over the next 12 months.
And Fidelity's research director, looking even further out, said the next cyclical bottom might be around 65,000, but not until 2026.
Right. So you have experts saying 56K now, and others saying 143K soon.
What does that disagreement tell us?
It tells us the rules have changed. There's this growing consensus from firms like Bitwise and 10x Research that the old four-year halving cycle, it's dead.
The predictable boom and bust tied to the supply shock.
It's gone, replaced by what they're calling the political and liquidity cycle,
Sure.
meaning the institutional scale is so large now that Bitcoin is driven by the same macro forces as any other mature asset: central bank policy, regulatory shifts. The BOJ pivot we talked about is now far more important than the halving.
So stop obsessing over block rewards and start tracking central bank balance sheets.
That's the new game.
So bringing it all together, what does this actually mean for you, the listener? You have this undeniable conflict, a necessary leverage flush. This short-term hurricane is happening at the exact same time the long-term infrastructure is being reinforced deeper and better than ever before.
The signal, if you just look past the daily price, is overwhelming.
I mean, Intuit is integrating USDC into TurboTax and QuickBooks.
Embedding stablecoins into the fundamental tax and small business economy, we saw a fully regulated national bank, SoFi, issuing stablecoins on Ethereum. This entrenchment into the power grid, the payment system, the tax code, that's the real story.
So this week, we saw sovereign nations like Bhutan and global networks like Visa adopt public blockchains for core economic functions. City building, global settlement.
Real-world utility.
So if Bitcoin really is transitioning from just a speculative asset to essential global infrastructure for AI and sovereign development, does its daily price volatility become less relevant than its utility?
That's the real question.
Should we stop tracking the daily ticks and start tracking which government, which corporation is next to adopt the Bhutan model, that sustainable conversion of renewable energy directly into national wealth?
That's certainly something to think about.